In June 2026, the Nasdaq stock market handed sudden delisting notices to two Asian cross-border issuers, Smart Digital Group and QMMM Holdings. These exchange bans followed severe trading suspensions by the Securities and Exchange Commission, which were initially triggered by unknown third parties executing social media pump-and-dump schemes to artificially inflate the stock's prices. But U.S. regulators never found evidence that either company actually orchestrated or participated in the fraudulent online promotions. Instead, Nasdaq executed these permanent exchange bans using a newly implemented regulatory mechanism known as Rule IM 5101-4. This signals the start of what appears to be a systemic containment strategy, a move by Nasdaq to tighten its grip on how foreign issuers access U.S. capital. Under this approach, a company doesn't necessarily have to commit a crime to be removed from the market. It just has to possess a corporate structure that regulators deem too risky to remain listed. For investors holding foreign microcaps, this means the risk of a total loss no longer depends on whether a company is honest, but on whether its architecture is susceptible to external manipulation. Historically, getting delisted from a major U.S. exchange required tangible proof. Regulators had to show evidence of internal corporate wrongdoing, or the stock had to fail explicit financial metrics, like dropping below $1 per share. Now, the exchange is applying risk-based structural standards. Regulators are evaluating a company's passive susceptibility to manipulation, rather than its active behavior. Rule IM 5101-4 targets specific vulnerabilities. The first is location. Regulators are scrutinizing companies based in opaque foreign jurisdictions with blocking statutes, local laws that prevent U.S. authorities from accessing corporate data or conducting due diligence. The second major vulnerability is a low public float. When very few shares are actually available for the public to trade, a stock becomes mathematically susceptible to extreme price volatility from even a tiny amount of trading volume. The third targeted vulnerability is a documented history of susceptibility to third-party social media influence or external hype cycles. By preemptively purging companies that simply possess the structural anatomy of a target, Nasdaq is choosing to remove the environment where fraud happens, rather than chasing the fraudsters themselves. To activate this new delisting power, Nasdaq relies on a mechanical prerequisite, a Section 12K temporary trading suspension issued by the SEC. These initial 10-day regulatory pauses are frequently triggered by unknown third parties hyping a stock online, an event that can occur entirely outside the company's control. Once that 10-day SEC pause is in effect, Nasdaq uses its discretionary authority under the new rule to convert the temporary suspension into a permanent exchange ban. Market participants have pointed out a severe lack of due process here, as the companies are often delisted before they can provide a meaningful appeal or prove their own innocence. Because corporate complicity is no longer required, the rule creates a significant loophole. Any malicious actor can now intentionally orchestrate a company's demise. A short seller or a competitor can simply manufacture an artificial online promotional campaign. That fake hype triggers the SEC suspension, which in turn hands Nasdaq the justification to delist the target. This regulatory architecture turns social media into a tool for sabotage, leaving compliant companies with specific structural traits defenseless against targeted digital attacks. The actual collateral damage of this regulatory policy falls squarely on domestic retail shareholders. This strategy creates a paradox. Protecting the broader market's integrity is coming at the direct expense of the individual investor. When regulators delist these stocks without warning, they inflict sudden financial loss on the exact public they are mandated to protect. Retail investors find themselves holding shares that are no longer tradable on a national exchange, trapping their capital in the illiquid over-the-counter markets. The compliance threshold for Asian cross-border issuers has reached a turning point. The United States capital market is now prioritizing the structural health of its national exchanges over the survival and liquidity of individual foreign equities. If your portfolio contains foreign microcaps with a low float, recognize that the criteria for remaining listed has moved from behavioral compliance to structural resistance. You are holding assets that U.S. exchanges now view as inherent liabilities. Thanks for watching the Wall Street Review. As always, this is not financial advice, so do your own research, and we'll see you in the next one.